One big piece of the Dodd-Frank Act is looking at reforming derivatives. This is an area where the financial institutions have been really focused and tracking very closely, but the reality is that derivatives reform could really impact any company that holds a derivative and is an end user of those derivative products. So what I really hope to drive the conversation is, how does this really affect companies that aren't financial institutions, and what should they be doing now about it?
Yeah, I think that's where the real meat will come out of the conversation is, what are they hearing? What are they seeing? What are companies doing? Best practices, and really bringing it to life.
We all know that the world of financial institutions have been turned upside down by Dodd-Frank with a number of requirements. The thing that non-financial companies have to deal with primarily as it relates to Dodd-Frank is the changes that Dodd-Frank have done to the derivatives market. And maybe the way to think about that is the financial institutions actually make the markets, but corporates use the product that financial institutions sell. Congress wanted to create a mechanism to drive more transparency in the financial markets as it relates to derivatives, because derivatives is one of the tools that creates that interconnectedness of the United States financial system, in fact, a global financial system.
Now, you're creating a change. And the simple change is two simple things. We need to report all our trades to a central repository so that the government has an awareness of the open positions so that they can see where the risk pockets are. And the second thing is there's a strong bias and a mandate for the financial institutions and a strong bias for everyone else to post collateral. And the reason for that is, on the back of the crisis, when these contracts started to take on bigger and bigger value, there were companies that were not able to pay when their big bets didn't pay off.
So if you're an end user and there's a counterparty you've used in the past and you go to them post this regulated world, you might A, see pricing differences from what you saw in the past, or B, be asked to post collateral when you weren't doing that before. Those are some possible changes.
Dodd-Frank doesn't require end users of derivatives to trade their derivatives on an exchange or clear through a clearinghouse. That said, end users of derivatives may make a decision based upon economics, based upon credit risk, based upon operations, that they do want to trade their derivatives on an exchange or clear through a clearinghouse, or continue to trade derivatives the way they always have. They have a lot of options available to them as to how they're going to execute their derivatives and clear their derivatives on a going forward basis.
Whether it's regulatory change or changes in the market, it's getting more expensive for financial institutions. The overall question is, how much of that and in what ways will those additional costs be passed through to the wider market? Any company that's looking at a supplier and knows that their supplier's costs are going up can expect pricing to change.
We see the biggest issue being the cost issue, where corporates are going to have to take a look at how they use derivatives, the cost of what they used to do, and we think those costs are going to go up, which means that they're going to have to reevaluate costs in the new environment.
So those companies that are really thinking ahead and are really in front of this, what are some of the key things they're doing?
I think what we're seeing end users do right now is evaluating the scope of instruments that they currently execute that could be captured by the regulation, and evaluating from a cost-benefit perspective whether or not it makes more sense for them to continue to execute the derivatives the way that they always have, calling up their party, trading with them directly bilaterally and clearing with them directly, versus possibly trading the derivative on an exchange, possibly clearing that derivative through a clearinghouse and posting collateral on a daily basis. And as part of that analysis, they're evaluating whether or not they have the infrastructure, including people, operations, and systems, to actually execute differently than they are today.
The corporate end users have been focused on the compliance costs because they can see them. Those indirect costs, they haven't been able to see them, but now they can because the pricing discussions have started and they can feel it.
And in the conversations I've had with treasurers and CFOs, Many of them have clearly stated that they are going to evaluate the cost and benefits associated with continuing to execute the derivatives to manage the risk that they've been managing historically. And if they find the costs to be too great, that they will evaluate whether or not they want to execute their
Right.
derivatives anymore.
That's a fairly heavy analytical exercise, especially for a corporate who is an extensive user of derivative trades to manage risk. It's the kind of thing where you have to look at the structure of the trade, both on an accounting basis and an economic basis, and look at how the infrastructure has shifted where you can get those trades. But it's a heavy-duty analysis. It's not something that is simple math.
The longer you keep it at the bottom of the list because you're focused on the direct impact and the fact that the direct impact of the regulation isn't quite yet clear is going to keep you from the more important focus of all the indirect impacts and costs. You know, if you're not focused on that sooner, this will catch you.
So a lot of tracking of what instruments are you using, which regulations apply to which type of instrument, and being on top of what's going on with the regulators.
And being ready to talk to your counterparties about the elements that will go into the price discussion.